Hello, everyone. This is Alexander Gerchik, and we're going to have a short webinar today, how to control the risk, where to put the right stops, and what to do with them. The most important thing, as you can see, I'm going to, in a few minutes, put the chart for you and explain. The most important thing when you put a stop is where the stop's supposed to be. We basically separating all the time the stops in two different ways. The first stop is the mathematical stop, which you basically calculating just a number, which depends, let's say, in the price of the currency or anything else. And another stop is the technical stop. What does mean the technical stop? For example, let's say we took a euro, right? Hold on 1 second. I'll put the price. Now you see the chart. For example, you have euro. And in euro, if you can see, we have very strong level of 114. What we're calling the level, where the price changed the direction all the time, where we have a lot of falls against that particular level. So what do we have in this case? We have a very strong level at 114. The most important thing, it's when, for example, you enter the, let's say you trade false breakout or you trade breakouts. The most important thing, it's the level, because all of the moves, they are begin from the levels. If you understand correctly the level, then you will understand the move. If you take a look at the price of the 114 for the euro, you can see that every time the euro was breaking 114, it was going straight up like 70, 80 points, and a lot of times, most of the times. Except in August, it was coming back, so it was a false breakdown. You see, one false breakout, second false breakout, third false breakout, fourth false breakout, fifth false breakout. So what do we have? We have a very strong level at 114. For example, if you figure it out and you want to get short, all the time we break at the price of 114. Every time the price has been breaking, we want to put a short stops. So what do we do? Obviously, the right thing, of course, is to put a short stop, very short. It means, obviously, we wanted to put the stop here somewhere at the 115, but the most important thing, the stop is too far away. If basically you put in the right thing into the stop, then your stop is going to be in a very right direction. Let's make a picture of it and I'll explain what do I mean by that. Let's say we have a level of 114. We'll make a print screen. That's what we have. As you can see, if you can see, we're gonna just point it out. Right here, right here, right here, right here, and right here. And obviously we're expecting some more moves. So for example, let's say we trade in a false breakout. The most important thing with the false breakout, you understand, I'm just gonna give a hypothetical example. The price of the, hold on 1 second. Price of the currency has to go right here up. Once the price of the currency is up there, then we put in the sell stop right here. If we trade in a false breakout. The most important thing, where to put a stop. We understand one thing. With the levels, the most important thing is the direction. If we see a right direction, then we can use the right stops, right sell stops, or we can right trade. Either it's a false breakout or just a regular breakout. So if you're going to see it, once we put a stop, we're expecting the issue to go down. Where to put a stop? Most of the time, everybody in the internet recommended to put a stop right here. Technically, it's right. But there's one very important issue. When you calculate in the stop loss, the stop loss most of the time is the percentage of your deposit. For example, if you have, let's say you work with a 2% stop loss per day and your deposit, let's say it's $1,000, you have a stop loss of $20. The most important thing, if your stop loss, for example, in this case, is going to be bigger than $20, theoretically, you cannot do the trade. So you have only one option. Find the way where you put a very short stop. So what do? Once basically the situation like this occur, you can either put the stop shorter for one simple reason. Why? You understand? If, let's say, euro went down and then it's coming back again, you understand the euro is going to go much higher. So it's no reason for you to lose more money than you're supposed to. So the most important thing is the technical stuff. I'll remove this. It's to understand where the currency is going. And then you can basically work out with the much shorter stops. Then another thing, which is a very important, where a lot of people having a problem, is the average true range, ATR. How we're calculating average true range is the high minus low of any daily bar. I mean, we're not taking a high, a close or open, we're taking a high, which is in this case, and taking minus low. So for example, figure out this. We'll put it this bar, and we'll have ATR of 123 points. That's the ATR for that particular day. So the most important thing, that the stop order has to be dependent on ATR. I'll tell you why. For example, the average through range for now for the euro is about 80 to 100 points. So let's say we'll take 90. So the most important thing, if you're calculating correctly, and intraday trading, we're talking about just the intraday trade. The stop not supposed to be bigger than the 20 points. Because if the stop is bigger than the 20 points, the math is not in your favor. Why? Because the 90 points, that's the ATR, and a 20 points stop, you only have a 4.5 to 1. In this case, you're fine. But if the ATR is going to go smaller, become smaller, let's say 75, and the stop loss is going to go higher, let's say, for example, 25, then you're not going to have a multiplication of more than 3 to 1, and that trade is not too good. So the most important thing to calculate, first of all, it's the a percentage of the deposit. It's ATR daily. It's the regular stop for your trade. The most important thing is how you trade. If you trade intraday, that's the one rules. If you trade a swing trade, you bought it tomorrow, you want to sell it in 1 or 2 days, it's totally different thing. I'm going to give you a few different examples just for you to see. Okay, what do we have here? I'll give you different examples where to put a stop, how to work with the stops, and the price. If you can see in this particular scenario, that's every time the price touched $38, it pulls back again, it goes up. So what does it mean? We figure out the first thing, it's a one very important level is the 38. In this particular case, there's a two ways you can enter the position. The entrance number one, you put the sell stop under 38, and thinking that the market is going to go lower and the stock is going to go much lower. So under 38, the price is supposed to collapse. Where to put a stop? You don't have to put the stop too high here. You can put the stop right above the level for one simple reason. In this particular case scenario, once basically the currency pair or a stock or a future anything, it breaks the particular price, it's supposed to have an impulse. It's supposed to go down and supposed to go down fast. If it doesn't go down fast, probably it's going to be a false breakout. So what does it mean? In a scenario like this, you should have a very short stop. You don't have to have a big stop for one simple reason. Once it breaks down, then it's going to go straight down. If it doesn't go straight down, put a short stop right above the level, and that's it. That's the one scenario. We'll go to a few different scenarios, so you'll see in every different scenario is a little different. Here, it's absolutely the same scenario. You see, you have very strong level. We had a false breakout against that level, and now it's a very strong level. So we know one thing for a fact. Once the level is going to be break 155, then that's it. Then it's going to go much lower. And if it's not going lower, then it's going to be false breakout, and we're going to go higher. So the most important thing is to identify the level first. Once you identify the level, then you work with the stops. Obviously, with the currency pairs, it's a little different because the currency pair, most of the time, they arrange instruments. For example, we take a very strong level at the Japanese yen at 84.35. You see, it's a very, very strong level. Once basically the Japanese yen go below that level, hold on 1 second. I'm going to show it to you right now. Once, twice, and go higher. So what do we have here? Theoretically, if basically we're trading the short side, we have to put a stop right above the level. But you should understand one thing. If we break it down and then coming back again right here, we generated the long single again, and we don't have to wait here. Because once we're going to break upside, then we're going to fly over here. So one simple reason, when you put a stop, the most important thing, it's where you locate it compared to other levels. Once you have very strong level, that trade that particular level. For example, we have a very strong level of 83. See? So what do we have? At that particular level, once we go lower than 83, you see right here, and close in there, we're supposed to go much lower. It's no reason to put a very high and big stop, so you can really have one very small stop. Because why? If the impulse is going to go down, then it's supposed to go down, and you can have a very short stop. So my advice to you, every time you trade, it doesn't matter where you trade. For example, we'll take a snapshot of the right here, British pound. Sorry. Okay, that's his level that we have right here. You see, basically you understand one thing. Once we break 155, we can really work with the short stop. We don't have to put a very large stop somewhere here for one simple reason. If we're going to break 155, close above 55 and go higher, you can put the straight stop right below the 155. That's the most important thing. My advice to you guys, when you trade, as I said, first of all, look at the ATR, average through range, if you trade intraday trading. That's the most important thing. Second of all, work with a fixed stop loss from the deposit, a fixed stop loss. So what does it mean? If you have, let's say, any amount of money, you have to have a stop which is always the same in the dollar equivalent. What does it mean? The number of points that's included in a stop can be vary, 10, 15, 20, 25. But the stop loss itself always have to be fixed amount. Let's say 1% of the deposit or 2% of the deposit, for one simple reason. If your number is going to be different, then you're going to definitely have an issue with the multiplication. What does it mean? If, for example, you have a 2% stop, then your stop always going to be the same. Let's say if you have 2% stop from a $10,000 is $200. So every time you lose 2%, you lose $200, which is fine. But if you're going to vary a different time of deposit, for example, at one point, you're going to lose $150. If you're using the wrong multiplication, let's say 3 to 1, 4 to 1, then you're going to have a problem. I'll write it down for you in the paper right now. Hold on, so you'll understand where the problem is coming. Okay. For example, 2% from a $10,000 equal $200. Look at this. And then every time you're going to put a different stop, 10, 15, or 20 points. Look at this. Without the concluding the number, you see, 10, 15, 20 points. Now I'm going to show it to you. For example, if on 10 points, you're going to make money multiplied by 3, you're going to make 30 points. But if in 20 points, you're going to lose, you see, on 30 points, you're going to lose. And here you made it 3 to 1, and here you lost. You see, You only have a multiplication every time, only 1.5 times, and a losing position. So what does it mean? For example, if you have a short stop, like here, you take position which is 3 times bigger. So this way, when you take position 3 times bigger, you're gonna have a profit much bigger than you have a losing day. So what does it mean? You always have to have a fixed number of losing trade. The most important thing, the stop loss always have to be fixable. I want to show you a few more different examples for you to understand. Hold on. That's another screen. You see it's already, I pre-built it for you. As you can see, there's a very strong level of 180. As I said before, if you basically identify a very strong levels, you shouldn't have a problem with the large stops. You can really work with a very, very short stop. So the most important thing here is to identify the level, find the right entrance point, and put a very, very short stop. As I said before, no matter where you trade, Australian dollar, Canadian dollar, it's always the same. First of all, identifying the level. Second thing is calculating the risk. Risk always have to be fixed. And then calculating the risk in points. For example, if you take a look at this level of Australian dollar, you have to calculate if you're allowed to put a right thing. But don't forget, here, especially at the low or at the high, you don't have to work with a very, very big stop. You have to work with a very small stop, because if we're going to break the low level, then we're going to go much lower. So when you work, let's say at extremes, at the high or at the low, try to work with the short stops. Here, when you work inside the range, you can work with a little bit bigger stop. When you go against the trend, for example, you're trying to short here, you always work with the short stop. When you go against the trend right here, also work with the short stops. I hope all of these examples that would really help you out. Try to put everything together. You know where to find us. We're at Gerchik & Co. Sending us email at agerchik@gmail.com. Ask us questions, and we'll be more than happy to help you out for one simple reason. We're, as a company, we are totally going to be fine if you're going to make money. No company is surviving without the traders. So when the traders are fine, when the traders are educated, when the traders are making money, that's how much money you make with them. So the best and the most important thing for us is to educate you, to teach you how to put the right stops, how to do right trades. And I'm sure you're going to make a lot of money. It was Alexander Gerchik, and I'm president of the Gerchik & Co. I'm a professional trader. I've been in trading from 1998. I've been chosen as one of the safest trader for HBO show Wall Street Warriors. So I'm sure I'm a person that you can really trust and learn from me. Good luck to you all, and all the best. Thank you.